I want to talk to you about using the volume profile indicator to make trades for day trading. The problem is on YouTube, most of the videos are not for day trading, but for long term, or sometimes they call them swing trading. This is what YouTube videos will show you. And what I have up here is this is the price chart in the upper pane. The middle pane is the volume profile indicator, and the lower pane is also a volume indicator. You notice that there's a difference only in that the green and red bars look the same, but there's this purple line looks different than the purple line in the bottom. And the difference is that the purple line in the bottom uses a three period or bar average. So it averages the last three, like 1, 2, 3, it gets the average. That's the purple line. Then 1, 2, 3 gets the average and puts. You can see that. Where is on this the middle pane here, it uses like a 50 bar average, okay? And so that's one important difference between these two indicators. You'll notice that this indicator has a 3 there, and this one has a 50. That's talking about 50 bars or 50 candles average. Now, the big picture is that this chart shows each dashed line is a day. And so if you count up all the dashed lines, it's 30 days. And you'll see that up here, each bar or candle occurs every 4 hours. And so if you look at the line which is the ending of a day, between days, try to look for a pattern. There doesn't seem to be a pattern, on this scale using a 4-hour period that the normal, swing trader or long-term traders use. But if you go into a day trader type of period, which is more like 5 minutes, now we're looking at each bar occurs at 5 minutes, and we're looking at there's 10 dashed lines or 10 days. And now we can begin to see a pattern. For example, see these spikes that occur? That spike occurs right there on the end of a day. This spike occurs at the end of the day. This spike occurs at the end of the day. There's a spike sort of there. Some spikes here. A group of spikes there. I think you get the picture. For day traders, most of the spikes occur at the end of the day and the beginning of the next day. And that's huge. That's huge. What this tells you is day traders should be using 5-minute bars to look at the volume, okay? And further, take a look at this. I'll make this bigger. And I'm going to zoom in a little bit so it becomes more apparent. Zoom. That might be too much. Unzoom. Okay. So what this shows you is if you look at the bottom chart here, this purple line is referring to a 3 bar or 3 candle average, that it zooms up at the end of the day 2 bars and comes down. So the big spike is at the beginning, like I said again, at the beginning or end of one day and the beginning of the next day. And then there can be spikes in the middle of the day. Those are cool. But then what normally happens is you get in the middle of the day, it's this kind of deadville, low volume. People aren't trading. The big trades are occurring at the end of the day or at the beginning of the day. And that's what the big time, when those movers and shakers of the stock world, the Wall Street brokers are doing. They're trading at the end of the day. So if you want to get, the purpose of this is if you want to get into the action, you have to learn to use 5-minute, at least in the 5-minute charts for volume, okay? This is for day traders action. Also, I talk about predictability. If you want to talk about, this is the stock called Roku. We can also look at other stocks. Let's look at SQ. Okay, in SQ stock, it becomes more apparent. You got a spike here, end of the day, goes down, and then another spike at the next day, goes down, normal, Dullville, back up again. So what I'm saying is, stocks can be predictable, especially day trading can be predictable. And so used to be afraid of day trading, but now it's not this time for the video, but it's not only predictable, it's much more safer to trade. If you use stop losses and conditional trading such that if the stock goes up, you'll win. If the stock goes down, you'll lose. That's the play. So for instance, here's the price of the stock here at the end of the day. So you enter and at this price at the close, and then you put in an order for the next day overnight that if the stock goes up, you win, and if the stock goes down, you put in a stop loss so that you'll limit how much you'll lose. But you're in and off. So even if the stock goes boom and tanks, it'll still, the stop loss automatically will catch the drop in price so that you have a known, predictable stop loss. Okay. So that's that lecture. The next thing I want to talk to you about is how we can use it for day trading. So what I didn't point out is on the last profile, the volume profile, they have these green bars and the red bars. And let me zoom in a little bit more so you can see it. See, this is the volume profile. You got red bars and green bars. Same here. They correspond to the price up here. There's red price bars and green price bars. Okay, red, in both cases, red just simply means that the price went down on that 5-minute period compared to the last one. If it's green, that means the price has gone up. So one would think that if you had several green bars, like in this case, at the end of the day, that would guarantee that the next day the price would go up. And I'm not going to show this, I'm not going to prove this to you, but it's easy to prove. Just go back and look at 20 days worth of data on two different stocks, and you'll see that there's no correlation to the color of these bars. So if you have several green bars at the end of one day, you would think that the next bar would be green and be up higher than before. That is not the case. It's not always consistent like that. It's statistically not viable prediction-wise. Okay? So I don't like those, and I get rid of. I don't use these bars. Instead, I use the tops of the bars and make a purple profile here. And then the green line here is the 50-day profile. So you got the purple bar is the 3-day profile, and the green line is the 50-day profile. And so what you'll notice is that the purple line goes up and down, but basically it goes up and down above and below this green line. And the huge spikes go way above the green average price. Now, what the volume bars tell you is that the volume's increased. It doesn't tell you whether, like, it might say whether the stock's sales, the volume decreased. I'm not saying. There might be 100,000 shares sold and 200,000 purchased, and so the volume bar then would be 300,000. There's no way to tell. I wish it was different. I wish that these things would tell you how many shares were sold and how many shares were purchased, but it doesn't. And if you can't use the price to tell that number. So all you can tell is there's a whole bunch of trading going on. So again, at the end of the day, if they're over here at the end of the dashed line, there's a spike there. That means the movers and shakers are buying or selling stocks. That's all it'll tell you. And you can tell it's a big spike because it's above this green average line. Now, this spike here is above the green average line, but it just might be in the noise. See, it goes down, it goes up, it's above the line. So what in electronics, you have a noise level, you know. And so I call this is a noise level, and it's not. These little spikes are just normal spikes. What you're trying to find is the big spikes, okay? So what I did in this middle, I took the green average, 50-day average, and just shifted it up by 40%. So if this is value is 1 here, then this would be 1.4. And what that does is it eliminates all the noise that's riding on the FM. It's like an FM signal noise, where the green line's a carrier wave. and it tells you there's a big spike here. And so what I did was I specified a table here. Purple is a 3-bar volume average. That's this thing. And the green solid, there's a green solid and green dash. The green solid and the green dash are both 40 or so bar. It's basically 50 bars, right? 50 bars, sorry. And then the dash green is also a 50 bar average, but it's shifted up by 40%. And the orange bars these are the orange bars. What that tells you is the bars in which if the purple line is above the green dash line, you'll get these orange trigger bars. We might call them trigger bars. It's saying the trigger bars means something is important is going on. That's in the price of the stock, and so you can use these orange bars to trade during the day, and we can look at several examples of that. So let me look at maybe make the price one a little bit bigger, so you can see. And so you can see it. We got an orange trigger bar occurred right there, and anyways, then the price zoomed down and whatever. Not a very good example. Let me give you okay, so anyways, they mean something. Usually they indicate that there's a change occurring. So for example, these 3 in a row, people are like, I want to sell. So the price goes down, and then it starts going back up again. Okay, this is something major's happen. I mean, the price is going up and down, then the orange bars happen, and something major happens to change the course of the bars. So we can look at lots of examples. So like here, the price is going up and up and up, and how do you know when it's going to stop? Well, this orange trigger bar occurs right there, and it's majors because it goes above the line. So what happens is, right there, you see the orange bar, and so you can get in on the next trade, and then the next trade it starts. If you get in right here, it goes down, and you say, well, what's the big deal? Well, maybe if you like this, it'll look like more of a big deal. But the price from here, what is the price from here to there? Here to there is about 50 cents. So that's about a 2%. You're trying to get a 2%. You can get a 2% trade right there. Boom, boom, based on the orange trigger level. All right. Another thing you can do is, you see how let me zoom in one more level. Okay, so at the end of the day, this is the last bar of the day, and there's an orange trigger bar. The next to the last candle of the day, there's another orange. So we have 1, 2, 3, 4 orange bars of the day. Okay, that's very important. That says there's a lot of action going. A lot of shares are being traded. So that's major. So shares are like a mass in the energy equation. M equals mc squared, mass times velocity squared. So it's hard to change mass. So for example, my granddaughter, she ran full speed and I'm standing still, and she ran full speed. She'll hit me and bounce off because I have a lot more mass than her. It's hard. The laws of momentum say it's hard. The thing with the bigger mass is going to win. It's going to continue. It can't change overnight. So we don't know if these shares, by looking at this chart all by itself, whether or not these shares, we know there's a whole bunch of shares being bought and sold, but we don't know what more shares are being sought or what are being sold. So what we do is we look at another indicator. Oops. I'm trying to make it so you can see it. There. This purple indicator is called a flow indicator. And so let's just look at the purple indicator. Purple indicator over the last few bars of the day is going down. Okay? So that this is the clue that tells you that this volume that the shares are being sold, this volume flow indicator is going down, even when these volume indicators are increasing. Basically, thing to note that when you have these orange bars, whether they're getting bigger, bigger, or less and less and less, the point is that there's the bars there, and then the purple line tells you the direction that it's going. And so what happens is, since the purple bar is going down, we would expect that tomorrow, likewise, the price goes down. And so, sure enough, the first bar of the day, boom, it goes down. And so if you're day trading on the first bar like I do, you enter the market here at this price, at the closing price of the day, and you put in an order. This is called a short, where you predict that the price of the stock is going to go down. And sure enough, it goes down based on this purple bar. And this is called a flow indicator. Notice there's a black flow indicator and purple flow indicator, and their names are up here: volume flow indicator at 130, volume flow indicator at 3. The 3 again refers to the number of bars. It's looking at 3 bars to make its flow calculation. This is at 130 bars. So again, in this case, the bar is 5 minute, which is what day traders like. So you notice that even in this black thing, it says it's going down, but the purple thing says it's going up. So day traders, you should use the purple one, not the black one, and you should just not use any flow indicator, but use into the settings and change the indicator down to 3. Hope that makes sense. There's some other situations that you should be aware of. Notice that this flow indicator has 100% and 0% is its vertical scaling. So what that means is if it's 50% or more, there's a lot of flow, versus if there's 0 to 50% less flow. So you might use the 50% as a rule of thumb. So at the end of the day, if the purple line is going down, and it's above 50%, that tells you still there's plenty of flow going on, right? I mean, it's like several orange bars. Now there's a really nice case. I call it the 1 bar and down case. If you look at the last 3 bars of the day, one last bar, second last bar, and third last bar, they're all these. In this case, it's all 3 on that day. But what if you find it? If we can maybe find a day which just has 1 bar. Here's a good example. Okay. So this is the last bar of the day, price bar, second last price bar, and the third last price. There's only 1 orange bar. What that means is there's not much interest in this stock on that day, at the end of the day. So since there's not much interest, the price is going to go down. You notice the price did go down. There was only 1 bar. And also look at the flow down here, the purple flow. The flow is going down as well. And you'll notice that from at the 50% level, all of it's below the 50% level. So 1 bar is really easy, 1 bar and down. When it gets, you have cases that might have 2 bars. Now again, this is at the end of the day when all the action happens. Oh, this is earnings call. I don't trade on earnings calls. That takes a lot more information before you can trade on that. Here's several bars, so there's a lot of volume, and you can see the purple's going up, lots of volume, prices going up, and again it's above 50%. Here's 2 bars, okay, so let's look at that case. These are a little bit more tricky cases because the last bar of the day is that bar, and it's an orange trigger bar. Second bar is an orange trigger bar, but the third bar of the day there's no trigger bar. So it's in two bars is like in la la land, because 1 bar and down is clear. 3 bars is, there's lots of volume. But we can still use the purple flow indicator, and it's definitely a lot more easier. So the purple is going down, the flow is going down, and so we'd expect the price to go down the next day. And so here's the dashed line, the end of one day, and the price does go down, even on the first bar. Where it gets tricky is sometimes when you only have 2 bars at 2 of the 3 bars at the end of the day, sometimes the purple line goes up. Then you would expect the line go up, Sometimes it does sort of a sideways movement or goes down and then sideways. Those sideways movements are a little bit tricky. What you got to keep, if it does the sideways thing at the end of the day, use the 50% rule. You know, like this case, if this was at the end of the day and it went sideways and it's above 50%, the price is probably going to go up. Even in this case here, see it's sideways, but it's above 50%, and look what happens to the price. It goes up.